Hello, and welcome to the Dr. Money Matters podcast, the show where we discuss important financial topics that were never covered in med school. I'm your host, Dr. Tarang Patel. Welcome back to another episode of the Dr. Money Matters podcast. My guest today is Rick Ferri, CFA, a well-known advocate of index fund investing and a name that many of you may recognize from the Bogleheads Forum. In this episode, we talk about passive investing. We talk about what you should do before thinking about portfolio construction, such as how to improve your savings rate, living below your means, and getting knowledge. And we talk about portfolio construction itself, and Rick goes into the phases of investor education, which he calls his core four, the darkness before you are aware of basic investing principles, the enlightenment when you first learn about these things, complexity, maybe over-tuning your portfolio, and then finally the final stage, simplicity. We go over some common scenarios about how to invest, and Rick gives some principles to think about before deciding on how to invest and what you should do before determining how to select your portfolio. And then finally, Rick reminds us physicians that even though we went to medical school, we are not special when it comes to investing. It's good advice to remember. Okay, welcome back to another episode of the Dr. Money Matters podcast. My guest today is Rick Ferri, a CFA, entrepreneur, financial advisor, retired Marine, and as many of you listeners may be familiar with Rick's work, he's a prolific poster on the Bogleheads Forum and a strong advocate for passive investments in the vein of the late Jack Bogle. So welcome to the podcast, Rick, and thank you for your service.
Well, thank you for having me.
So you were in the Marines, correct?
I did total of 21 years, 8 years of active duty, and then 13 in the reserves.
Wow. I was also military, but I was much more removed from the front lines. You being in the Marines, I was probably about the opposite end. I was a radiologist in the Air Force, sitting way, way behind you guys.
but an important job nonetheless.
Well, thank you. So, I wanted to bring you on the podcast today talking about your approach to investing. And like I said, you're a strong advocate for index investing, passive investing. And so most of my listeners are working healthcare professionals, a lot of early to mid-career physicians, dentists who have pretty good incomes, but are not so well educated in terms of how to structure investments, a little bit leery of the financial industry, but not confident in their own skills about how to do this. So let's talk a little bit about how to do that. But before we get into that, just tell me how you ended up in the investing world.
Well, I have an undergraduate degree in business administration that I received from the University of Rhode Island back in 1980. But I always had an interest in the military. I was an Eagle Scout, and my best friend in high school went into the Army instead of going to college. And I've always maintained an interest in the military. So in 1980, it was a very bad time in the economy. Interest rates were double digits, and the unemployment rate was double digits. And I was graduating from college at that time and decided to serve my country by going into the military, and I chose the Marine Corps. I should rather say they chose me because you have to apply to get in. And I decided I was going to do that for a while. I ended up going to flight school and becoming a jet pilot and did that for a while. So about 8 years later is when I left the Marine Corps active duty side and took a job with one of the Wall Street brokerage firms, and that's how I got involved in the investment industry.
So when did you kind of make or get the idea about passive investing, or when did that light bulb go off for you?
Well, I had done a lot of work when I went into the investment industry. I wanted to learn as much as I could, so I started working on the Chartered Financial Analyst program, CFA program, which is a 3-year self-study program, but very intense and very difficult to get past the 3 levels of exams. But this was the certification that all of the portfolio managers had and the analysts on Wall Street had. So I wanted to have it. I wanted to know what they knew, at least the base. And so I went through the program, and then I started working on my Master's of Science in Finance degree. And my whole theory was I was going to find a way to outperform the market, because that's sort of what your thinking is when you go on Wall Street. There are people out there you're led to believe who can consistently outperform in ways of doing it. All you have to do is figure it out, and then you can make a lot of money for your clients. You can make a lot of money for the firm you work for, and of course, you make a lot of money for yourself. And that was the whole concept. So I set out on a quest to do that, and I wasn't doing it. It wasn't happening for me, and I was looking around, and it wasn't happening for just about everybody that was trying to do this. I started monitoring the results and doing benchmarking of portfolios very closely to various indexes. And sometime in the spring of 1996, I was at a CFA conference in Atlanta, and Jack Bogle gave a presentation. And he talked about exactly what I was seeing. He was talking about the fact that most professionals don't outperform and that indexing outperforms. And that was really my first hit that I need to get involved in this. I need to find out about this. So I went and I bought his book eventually, Bogle on Mutual Funds. And in October of 1996, I started reading his book, and it just hit me like a bolt of lightning, what he was talking about. And he was absolutely true. And there was a lot of people out there like me who had come to the realization that what we're doing as advisors is wrong. We shouldn't be steering our clients to these products that are trying to outperform the market. We should be using index funds that are very low cost and creating portfolios of index funds that will produce the best returns in the long run for the clients, which is really what the game was all about. And I completely changed my philosophy and eventually left Wall Street and started my own company to do that.
So did that realization, did that put you at odds with most of your Wall Street colleagues?
Professionally, in other words, on the outside, yes. It put me at odds, meaning the CFA at the time was mostly about people who were going to be analysts and portfolio managers who were going to try to outperform. I'm saying what's put out there to the public.
Right.
However, when you talk to them individually, when you get a couple of beers in them at the bar, you find out that most of the biggest players on Wall Street have most of their money in index funds. They're not buying the products they're selling to the public. And it didn't surprise me because they were, had been in the industry a long time. They'd seen a lot. So for the major players, if you will, to have most of their personal money in indexing when you've got it out of them did not surprise me at all.
Right. So this is where I think a lot of people now, there seems to be a huge shift towards this. And even though it may not be the vast majority of assets yet, most people are saying in the professional industry and in common conversation that they're buying index funds. And I think Vanguard for the last few years has been consistently taking in more in assets than the rest of the funds, other companies combined. In fact, it's like the other companies are losing amount and Vanguard's taking in that amount plus some. So what impact do you think that the shift to long-term passive investing is going to have on the financial industry as a whole?
Well, it's already starting to drive down costs because the index fund fees are so low, less than 0.1% in most cases. The active funds, the traditional mutual funds that try to outperform the market, are having to lower their fees because they can't compete with the low-cost index funds. The words cost matter, which John Bogle is fond of saying,
right,
is important. The Wall Street only produces a certain rate of return. In other words, there's a hard dollar amount that is earned in the stock market every year. You can get it down to the penny. This is exactly the amount of money that was earned in the stock market in 2019, 2018, 2017, whatever, down to the penny. You know exactly how much dollars money was actually earned. The question is, where did it go? Who got it? Okay, did the investors get it? Or did the intermediaries get it? The brokers and the fund managers and so forth. And over the very long term, about 1/3 of the money that is earned in the stock market gets siphoned off to fund managers and traders, hedge funds, and so forth in the form of fees or commissions, spreads. 1/3 of the total amount of money that the stock market generates gets siphoned off. So if you in your portfolio can get that number way below 1/3, if you can get it down to like 0.1, then you're going to earn your fair share of what the market earns. And you're not going to be paying the intermediaries. And that's really the bottom line on indexing. It is not that the people who are managing the money are stupid, because they're not. Not the people that are trying to beat the market are stupid. They're not stupid. But the fees just erode away the returns over time. And if you can eliminate the fees through indexing and just have a diversified portfolio, your performance is eventually going to float to the top, and you're going to be in the top 10% of all investors that you know over your lifetime.
Right. And do you think also that some of the take away the fee part of it, because obviously, like you described, that's a major component to the underperformance of most funds. But do you think that indexing itself also just encourages better in investor behavior because you're less apt to trade in and out of things?
That's questionable, because the way that a lot of index funds are being used now, particularly exchange-traded funds, which are index funds that trade during the day on an exchange rather than at the end of the day. Typical mutual fund just trades once a day at the end of the day. If you go to Vanguard and you buy one of their funds directly, it trades it once a day at the end of the day at whatever the NAV is, net asset value. With an exchange-traded fund, that same fund would trade during the day at whatever the market price is. And so you can trade it all the time if you want to. Okay. So ETFs then are in many ways a trading vehicle. And probably 85% of exchange-traded funds are being traded all the time. So some people have started using exchange-traded funds, but not in a buy and hold way. Some do it buy and hold, but some buy and trade. And that's just as bad as trying to trade stocks in many ways. I mean, you're not going to get anywhere doing that. You just, instead of buying one stock, you buy all the stocks, or instead of buying ExxonMobil, you buy an energy ETF that has follows an energy index. But there's a lot of trading of exchange-traded funds going on. So to say I use index funds doesn't always tell me much. It just tells me you're not out buying individual securities anymore, but it doesn't tell me whether or not you've stopped trying to beat the market by actively trading these ETFs.
Okay, that's actually a good point, because I think a lot of people are under kind of the misconception that, okay, by reducing the active management component of it, that's what you need to do. But what you described is perfectly, I think, encapsulates what seems to be really happening. And even the professionals who advocate some of the index fund ETFs are kind of doing that. And that kind of goes to the growth of now. When Vanguard started the index fund, when John Bogle started the index fund, you had very limited. I mean, the S&P 500 fund was the first one, and for a long time, the only one. As now we see more and more indices and niches and sectors come about and are easily accessible for the individual investor, the ease with which we have access to it makes it somewhat dangerous too. So I think you're right. Just by itself, it's not one thing or one way or the other, doesn't preclude good or bad behavior with investing. So talk to me a little bit about how you'd written on the Bogleheads website and your own website about portfolio construction. So talk to me a little bit about your approach in constructing a portfolio.
Well, sure. First of all, before you even get to portfolio construction, you have to do a more basic analysis of yourself, your budget, your expenses, your income, and you need to be able to live below your means so that you can accumulate some money that you can invest. So the number one thing for people when they're first starting out is to figure out how to put away 10% of their income and not run up credit card debt at the same time.
Right.
So, you've got to live below your means no matter what, because living below your means gives you the capital that you can accumulate to invest. And when you're just starting out, accumulating capital is much more important than the rate of return that you get on that capital. In other words, if you put $1,000 away one year and you don't put any more money away for another 10 years, who cares if you get a 50% return on that $1,000? It's not going to add up to much.
Right.
You've got to get money accumulated through savings first. So having a savings plan and a savings discipline is the most important thing to do at the beginning. Once you accumulate $100,000, a couple of $100,000 in savings, now the rate of return on those savings begins to become important. And once you get up to $500,000, and it really takes about that much money, now the rate of return on those savings, if you can eke out an extra 1% because you're cutting the fees down or you're not trading as much and you can eke out a couple of percent more, now it begins to make a real difference in your portfolio. So I tell people, get your savings plan down first and then worry about the investment plan.
Right. That's actually, I'm sorry. I was going to say that's extremely important. And most of my listeners are kind of late in that because, they've spent so much time in graduate school, medical school, residency. And so they end up, you kind of get a dual-edged thing because you're behind your colleagues who've been working for a number of years. You have a much higher student loan burden. And then you also have that, well, I've been spending all these years as a student, and now I'm in my mid-30s, and I kind of want to live a little. So that you're absolutely right. And that's the thing that I advocate. One of the key things on this podcast is to at least initially, once you do start making physician money, to live below your means and build that portfolio. So absolutely, I'm glad you brought that up because that's a message that you can never hear enough.
No, and unfortunately, a lot of people go out and buy the Mercedes, they buy the big house, and they rack up so much debt that it's very difficult. Like I said, you can put money away, but if your debt is increasing at the same time, you're not putting money away.
Right.
So you've got to live below your means. I mean, instead of buying a $8 bottle of wine, go out and to the world and start working and making money, maybe you could bump that up to a $12 bottle of wine.
Right.
But that's about it. Unfortunately. The rewards come. You have to be patient. The rewards come later. And you work very, very hard to get through this. It's difficult. Look, nobody said it was easy. I mean, it's hard. It's hard for everybody. And I know it's hard for physicians because you rack up a lot of debt. It's just hard for everybody to figure out a way of having positive cash flow at the end of the month where you could put money away. Now, if you have an employer who has a 401k plan or a 503b, where they're going to match your contributions, well, for sure you want to do that. Mm-hmm. There's no doubt, because that's just free money because of the match. But you've got to have positive cash flow at the end of the month so that it could accumulate money in which to invest. Now let's get to the investing side, which is what your question was. Well, in the long run, stocks outperform bonds. Bonds outperform cash. Cash basically matches the inflation rate. By cash, I mean leaving your money in the money market. So if you've got many years to go, and you do, if you're 35, 40, you're going to be working for another 25, 30 years. There's no reason why you should be doing anything except being aggressive and having your money go into the stock market and leaving it there. Don't touch it. Don't look at it. Don't care about it. Don't think about it. Don't mess with it. Just go and do your job, accumulate money, put it in a low-cost stock index fund, and forget it. That's the logical, technical thing to do. That is, if you're going to look at the math, just the math, that's what you do. Unquestionably, that's what you do. Unfortunately, we are not made of mathematical equations.
Right.
Okay. We are made of emotional things. And this is where having perhaps a balanced portfolio where you have both stocks and bonds in your account. But the easiest way to do that is not to try to do it yourself. Go and buy a balanced index fund that has stocks and bonds, like a Vanguard have life strategy index funds, or even some of the target date funds. I'm not so hot on that. I'd rather just use a life strategy index funds. But these are index funds that have both stocks in there and bonds in there that are balanced to, say, 60% stocks, 40% bonds, something that makes the portfolio a little less volatile than all stocks, still gives you a rate of return that you need to get to where you need to go. Put the money there, automatic, invest in it, automatic, rebalance within the fund. The more you automate it, the more you make it hands off, the better off you're going to be. If you can set it and forget it and just have the money come out of your account automatically invested in aggressive type portfolio and don't look at it, just leave it alone, then 30 years from now, when you look at it, you go, oh my gosh, I got to have a lot of money. In fact, you will have more money than everyone else in your graduating class. I guarantee it. You're going to, because they're all messing with their portfolios. And then getting financial advisors who make things all muck complex and add this and add that. And now we got to do this and now we got to do that. And if you don't do any of that, just buy a low-cost index fund, balanced index fund, or if you can do it, just an all-stock index fund, and just leave it there and don't touch it and don't look at it. You're going to have a lot more money later on down the road.
Right. Absolutely. But you're also right that the behavioral component of humans makes that tough. When you hear other physicians talking in the doctor's lounge about the latest biotech stock or something like that, you just kind of have to let those things go in through one year and out the other. But can I give you a hypothetical, like a little bit more of a concrete scenario, and maybe you kind of go into how you would approach that?
Sure.
Okay.
We could try that.
Yeah. So let's say you have Dr. Jones it's about a 38-year-old hospitalist who's got two young children, like 8 and 4, and a working spouse. Combined, they make about $350,000 a year, but they still have about $300,000 in student loan debt, and they have a mortgage of around $600,000. They do both work, and they do max out their 401ks to get the match, and have, let's say, about $300,000 in those. But they're currently paying the minimum on their student loans and about a 30-year mortgage. But the question that always comes up with this scenario, and I see this kind of a lot in the various physician social media groups, is they've done the 401ks, so they're getting the matches. Should they now pay off their loans, or should they put it in a taxable account? They have children. Should they open 529s? Obviously, I know the answer is variable depending on the interest rates and things like that, but how would you approach that, and kind of what questions would you want to know from them?
First of all, I would want to know the interest rate that you're paying on your student loans. I would want to know the interest rate you're paying on your mortgage. Because if you're at a low interest rate, then you would just pay it off over time, and especially the student loan side of it. The mortgage, you can remortgage at a lower rate. And so that's number one. So in other words, you are issuing a bond, if you will, right, when you have debt and you have a mortgage. You're issuing a bond, so you're paying interest on that bond. There is a tax component to that where the interest on the mortgage is tax deductible, or could be tax deductible depending on your tax bracket, depending on how many other itemized deductions you have and so forth. If you have a $600,000 house, you're going to probably be able to itemize your deductions. But so there's a tax component to that. So you need to figure out what the cost of money is. Right. What are you paying for money? All right. And then you have to look at what kind of rate of return can I get if I don't pay off everything, or if I don't I'm going to make my normal payments, but I'm not going to accelerate payments. Instead, I'm going to take the money and I'm going to put it into a savings vehicle. And before we talk about the savings vehicle, what kind of a rate of return can I get on that? Now, the savings vehicle. 529 plan for the children, excellent savings vehicle because you're going to have to pay for your children's college education in the future. So you should have a savings plan for that anyway, regardless of whether you're paying your mortgage off or paying down the student loans. You really need to set up those 529 plans and have them go into, again, low-cost Vanguard type index funds because there's a tax benefit to it. That money will grow tax-free if it's taken out and used for college education for your children. So you got to take advantage of that. And that's tax-free money. That's not tax-deferred money.
Right.
Tax-free is better than tax-deferred. Tax-deferred means eventually you're going to have to pay taxes on it, the larger amount. Here, you pay no taxes if it's used for the children's education. And the other benefit of a 529, as you said, is in this case, you've got two children. So if one doesn't use it or one gets a scholarship, a ride or whatever, the other, you can use it for the other one.
Right.
And so you can move the money around, which is an excellent thing. The disadvantage of it, of course, is that the money that's in a 529 gets looked at on a FAFSA form to determine whether or not you're going to get financial aid. But given the income that these two people have, you're not going to get financial aid anyway.
Exactly.
So, doesn't matter. So now that you've got all of this bracketed out, you're going to do the 529 anyway. You're going to put money there anyway. If you have money left over, what do you do with it? Well, again, it's all based on what are you paying for interest and what can you get on the money. And you have to look at the stock market as returning the inflation rate plus the dividend rate plus the economic growth rate. And if you add those three things together, the dividend rate right now is about 2%. The inflation rate right now is about 2%, maybe a little higher. And the economic portion of that growth rate of the economy is, call it 2% because that's what the Fed is. Well, you add it all up, maybe 7% from stocks. Bonds right now, maybe 3%. So if you had a 50-50 portfolio, you would get 5%. And I don't think you should have 50-50. I think you should be more aggressive. So you're really targeting 6% rate of return. Now, that goes into a taxable account because you've already maxed out all the non-taxable stuff. 6%, you have to pay taxes on that. Now you're back down to an after-tax return of 5% because some of that is taxed at a lower tax rate. So 5% after tax. And you have to compare that to what your cost of money is. If your student loans are 10%, well, heck, you're going to pay off your student loans.
Right.
But if your student loans are 2% or 3%, then you're going to invest the money and you're just going to pay off your student loans as you move along. So there's a lot of moving variables to this. And there is not one strategy that fits everybody. And I tell people there are three components to a successful investment plan. Three. Number one, you have to have a philosophy. How are you going to invest your money? You're going to do it passively, low cost, not going to try to time the market, not going to try to buy that biotech fund, any of this stuff. You're just going to do it the way I said it. You're going to put the money away and you're going to leave it there and you're going to let it grow. So there's a philosophy of how you're going to invest. And then there's a strategy. Strategy is which funds you're going to buy, in which accounts, for what purpose, how are you going to use money. That is very personal. Now, the philosophy of using index funds is universal. Everybody that's using index funds for the most part believes in low cost and letting your money grow. That's the philosophy. So we all have the same philosophy. My way of implementing it, my way of doing it is going to be very personal based on my situation. So my strategy is going to be different than your strategy or this person, this scenario you gave me, their strategy. And each of us individually has to figure out what's in our best interest. And this is the hard part. That's why people listen to podcasts like this. It's why they read books. It's why they get a financial advisor. Problem with getting a financial advisor is there are good ones and there are bad ones and there are very bad ones. Okay? Good, bad, very bad. So you have a 1 out of 3 chance of getting a good one. Right? Okay. Anyway, so now you've done what I just talked about and you've come up with a strategy. You've come up with a plan. This is how we're going to do it. The next thing is you've got to be disciplined. You've got to implement it and you've got to maintain it and you've got to be patient. I mean, it takes a long time to do that. It takes decades to see this thing actually through. You've just got to be very patient about it. You've got to be disciplined about it. And you have to continually kind of go back and look at why you did things to remind yourself. And it helps to tell others about it as well, to sort of get a community, which is what you're creating with your podcast. Create a community where you can talk about these things so that you can all help each other stay disciplined. So those three things. You have to have the philosophy of wanting to do it and wanting to do it the right way. Then you have to have the strategy, which is very personal to you, which you have to figure out or get help from somebody else to figure it out. And then you have to do it. You have to implement it and you have to maintain it. You have to be patient about it. And that is the hardest thing. But those are the three elements of a successful plan.
Yeah, absolutely. I think the last part that you talk about, everyone gets very excited when they first learn about these things, and then they'll put a strategy together, but then the patience required. It's like working out. You're very hyped up in January, and then by March, April, like no one's left at the gym other than the people who have consistently been going for years. So the same thing applies here, and the discipline is tough. And the one thing that you brought up earlier, it's a good thing, is that unlike going to the gym, now once you set up the strategy and you can automate it, it does help a lot because it's already going out and doing that for you. But the idea that, it does take a long time for the underlying savings assets to build. And then, the power of compounding really happens much later. And then when it does happen, obviously it happens immensely, but it's very hard to visualize that when you're early in your career, that 30 years from now, when your portfolio has grown significantly and each year throws off a significant amount of growth or income, whatever you need, it's very hard to visualize that early on.
Yeah, it's super hard. But again, when you decided you wanted to go into the medical industry, you talked about a fellow who's in his mid-30s here. Mm-hmm. It's probably back in college or something where you decided, or maybe even high school, you decided, I want to be a physician. And it takes you 15 years to get there. Right? Well, that's patience, that's discipline. And all I'm saying is you apply these same things to your investment portfolio. That's all. Look, when you get married, it takes patience and discipline to hang in there I've been married 35 years to the same woman. And I have to tell you a joke. I play pickleball, which is kind of a version of tennis, only it's smaller and you play with paddles and a hard ball. And it's a lot of fun. Anyway, one of the guys I play with, he was my age, I'm 60 and he's 60. We happened to be talking about marriage. And I said, I've been married 35 years. He goes, yeah, me too. The first wife I was married to for 17 years. Second, I was married to for 8 years. And the third one I've been married to for 10 years. Anyway, so my point is that in order for you to get to where you are, you had to have been disciplined. And in order for you to do the job that you do, you have to be extremely disciplined. You can't just walk in one day on a patient and go, hey, I look at you and I think you got cancer and turn around and walk out. No, you're never going to do that. You've got to go in and you've got to do the tests and you've got to do the analysis. You've got to be very specific about what you do, very professional about what you do, very disciplined about what you do, and very patient to come up with, the right diagnosis or whatever for a particular patient. And this is what you've trained to do. All I'm saying is take that and apply it to investing.
Right.
That's all.
That's absolutely. I had a previous guest on, and I know Dr. William Bernstein. Yeah, basically similar thing. That's how he ended up writing his financial books, as he tried to apply the same scientific rigor that he had done to some of the scientific papers that he had looked at when he was in practicing medicine. And so it's absolutely right. Just methodical, disciplined approach. I mean, that's just good advice for life in general. But let's go a little bit more into the Core 4 program. Tell me a little bit about that.
So I, over my last 30 years, have come to a realization that there are 4 levels of a investor's education. 4 levels. The first level I call darkness. And darkness is what most people are in. It's basically the 2 doctors sitting at a table discussing a biotech stock. The whole idea is that we're going to, get rich by buying something that is going to go up a lot and it's going to make it for us. It is not really understanding what this is all about, not understanding the big picture, going out buying what other people tell you to buy, or just not doing it the right way. You're investing in darkness where all you can do, unless you get very lucky, and it is luck, unless you get very lucky, you could do very well. But most of the time, you fall behind, and then you try something else, you fall behind. Until you get to the point where you'd said, this is enough, I've got to figure out what's going on here, and you start really digging into it like you did, and you found the Bogleheads Forum, you started reading about indexing and reading about what's going on in the industry, and lo and behold, at some point, if you are honest with yourself and honest about what this industry is all about and honest about what other people are trying to do to you out there, even though they say that they're your trusted advisor, you will come to the epiphany that index investing and low-cost investing is the way to go, and not trying to beat the market. Just put it away for the long term and sit on it no matter what. Stay the course, as John Bogle would say. And you have this epiphany, this enlightenment. So the second stage out of darkness comes enlightenment. You have become enlightened. After you become enlightened, though, if you keep on going down this path of indexing and reading and learning, you start reading about all these things called factor investing and optimal portfolio allocation and on and on and on. A lot of complex topics that get wrapped up around this idea of passive index investing, which isn't really passive and it's really not indexing. And you begin to go down these rabbit holes that have no bottom to them. And you try to come up with the optimal allocation, the optimal portfolio, the optimal mix of this and that and that and this and this and that. And should I have 13.7% in emerging markets or 13.2%? I just can't make up my mind. Anyway, it's just you become overly complex and it becomes paralysis by analysis, and you end up changing things a lot, and you actually regress back somewhat into darkness. And it doesn't do you the epiphany that you had and the enlightenment that you had doesn't really do you that much good, because you got involved too far. And so complexity is the third level that people get to on their quest. At some point, you'll say to yourself, all of this stuff I've been doing, trying to find the optimal portfolio, trying to find the factor investing and FAMA French and three-factor modeling and DFA and this and that and on and on and on and on. At some point, you begin to realize that none of it matters. None of it matters. What really matters is how much do you have in stocks and how much do you have in bonds. That's what matters. All this other stuff only matters to the people who are trying to sell it to you. That stuff might generate a higher rate of return, but if it does generate a higher rate of return, you don't get it. It doesn't come to you. It goes to them, okay, in the form of fees, advisor fees, higher fund fees, commissions, and all of that. And you come to the second epiphany, if you will, of, wait a minute, I don't need any of this. All I need is a simple portfolio of a few index funds, and I will achieve my goal. That's all I need. I don't need all this other stuff. And now you've reached the fourth level, which is called simplicity. And now you can go back to your portfolio and you can say, how do I get rid of most of this stuff that I bought because I was trying to make everything optimal? And you just end up with a total U.S. stock market index fund, some sort of a bond fund, or maybe even just a CD ladder of some sort. And that's all you pretty much need. You could add some international index as well. You could add maybe some real estate in there through a REIT fund. So now you're at a maximum of 4 funds: U.S. stocks, international stocks, some real estate, and some bond component, the core 4. You don't even need all 4. But if you're going to do this and you want a little bit of something in there, core 4 is all you need. You don't need any more than that. I could argue you could use less than. And that's it. So you develop a portfolio using these 4 simple index funds from Vanguard or from Schwab or from TD Ameritrade or State Street or iShares. It doesn't matter. It really doesn't. Okay? Just use these core four, have an allocation between stocks and bonds, stick with it for 30 years, and you're going to be so much further ahead. Or go to Vanguard and buy one of their balanced funds, their Life Strategy Fund. What is in there? Life Strategy Balanced Fund has total U.S. stock market, total international market, total bond market, and then they have something called a international bond fund, which I'm not too hot on. I personally would substitute a real estate fund for that. But it's, again, they have their own core four balanced fund. So, and I can't say my balanced core four is going to do better or worse than their balanced core four. It becomes a nothing argument anyway. So just do that. That's simplicity. Once you get to that point, now you can just go to work every day, put the money away, don't worry about it. I don't know and I don't care about what happens to the stock market. I'm just going to work. I'm going to put my money in this simple, low-cost portfolio, and I'm done. And I'm doing that for 30 years. And in the end, after 30 years, I can retire, but all of my doctor friends around me still have to work for another 5 or 10 years because they don't have enough money.
Yeah, that's true. I think, the stages that you described are very accurate and very much a struggle to get to, because I'm still, I think, in that between the second and third stage, kind of figuring it out and realizing that I'm not. In the past, I haven't been successful at this, tinkering, adjusting, reading, and then you're right. You start looking at it and you're like, what are you doing? You're just wasting time for very minimal potential benefit. And most of the time that benefit never really materializes. But so
yeah, that's exactly it. And when you get to that stage, when you get to that point, that Jack Bogle level, if you will, you have reached the pinnacle, if you will, of how to be a successful index investor. So now you've got the philosophy, you've got the strategy, which is simplicity. All you got to do is implement it. And if you can figure out automated ways of doing it, you've got the whole thing there. You put it all together. You understand why you're investing this way through philosophy. You have the actual portfolio you need, very limited fund portfolio, just a few funds or maybe just even one fund. And because it's simple, it makes it more disciplined. In other words, your discipline and simplicity go hand in hand. Mm-hmm. If it's simple, it's easy to be disciplined. And then if you can automate it, it's easy to be disciplined. So it all works together. And if you can get to that stage, if you can get to that point, then you're just so much further ahead. That's why at the beginning of the conversation, when you said, hey, just people are buying index funds and are they doing it the right way? Well, that's the beginning. That's the first step. Finding out about index funds is the first step, and embracing the idea. But you're not done there. There's a whole educational process you have to go through. And to tout a book that I'm writing right now, that I'm self-publishing here and in the next few months, it's called The Education of an Index Investor. And all of this is in it. And it's only a 100-page book, so it's not very long. And it's just going to talk about all these concepts. And I'm going around the country with a presentation, and I'm giving it to investment groups, I'm giving it to financial planners, and it's all exactly what I just talked about. It's the 4 stages of an index fund investor's education, and then it's these 3 key elements of being a successful investor: philosophy, strategy, and discipline, and how it all works together, and the core 4 idea of what a simple portfolio looks like, putting it all out there. This is what you're striving for as an index investor. And if you can get there, you're going to be a lot better off.
Awesome. No, that's true. And if you come to the Phoenix area, please let me know. I'd love to come see the presentation. Let me ask you a couple of other questions though. And this is something that a lot of people will say, well, it's not adequately addressed by index investing. And that is, we talked about investing in real estate and REITs, but people who are very pro-real estate investing are more likely to say that, well, you don't get the true tax benefits and the ability to leverage from that. What do you think about that as part of a portfolio? I mean, like not just a REIT, but truly investing in properties and things, apartments or whatever.
Sure. I mean, remember what we said, there's philosophy and there's strategy. I don't do that personally because I never kind of got into that, but I know a lot of my friends are very much into investing in rental properties. Mm-hmm. So their portfolio is going to look different than mine. It will. That's what the strategy comes in. That's where strategy is personal. So who's right? Who's wrong? Everybody's right. If this is what you do, if this is how you're investing your money, you're going to do it through direct real estate because of the tax benefits, and you have the skill, the knowledge, experience to be able to do that, then great, good. I mean, that's a business. That's a small business. That's not investing in the public markets. Everything I was talking about was investing in the public markets, right? So if you say, well, I have this other business on the side, it happens to be real estate, great, good. I have a business too. I have a publishing business. I have an advisory business. Okay, but that don't count that as far as a part of my asset allocation in my public market portfolio. But certainly if I was in real estate, I probably wouldn't have REITs in my portfolio. I just say I don't need it because I'm doing real estate publicly. I mean, real estate privately through my business. So I wouldn't have it. Again, that's where the strategy portion comes in, where my portfolio of index funds would look different than yours.
Right. No, that's good. I think that's one issue that seems to come up quite a bit. And some of it, I wonder if it's just not a byproduct of what you described, the bad financial advisors, the distrust that people seem to have in a lot of Wall Street. So they're going completely outside of Wall Street and doing this. But there's bad actors in all these fields, and you kind of have to do your homework no matter which side of the investment process you're on. So I think you're right. You have to treat it as a business. And if you are willing to do that, by all means. Let me ask you one last thing about index investing that some people have brought up is that you see, at least you hear about companies now staying private for longer, like these big unicorn companies like Uber, Airbnb, whatever. Do you think that would have an impact on index investing in the future? I mean, you might be missing out on the growth companies of the future.
There are 3,600 companies in the Vanguard Total Stock Market Index Fund, maybe 3,700. The addition of one or two more Uber or Airbnb isn't going to make any difference. If you're talking about participating in venture capital, in other words, you want to get in on the ground floor with these companies before they even come public, that is way, way outside of my realm of expertise. And by the time a venture capital fund is offered to a physician, a young physician, it has been picked over 1,000 times by people who are knowledgeable about this stuff. And all you're getting is the leftovers. You're not getting prime cuts of meat by any. You're going to have to pick some whatever's left of the bone. That's what you're going to get. When your brokerage firm comes to you and says, I've got this great private equity offering or this great venture capital offering it's exclusive to just people like you because you're our favorite client, you should run away because what's going to be in that portfolio and what that is crap stuff. That stuff doesn't go to you. It's gone. And you cannot benefit. But I'll tell you what you end up doing. You end up tying your money up in something that has high fees. It's a high commission to get in. You can't get out of it. It becomes a thorn in your side eventually down the road. So I like the idea of going out and buying some condos or something and creating what you said earlier, a rental business that I can 100% control, rather than doing something where I'm going to turn my money over to some venture capital fund I know nothing about, but it was recommended to me by my broker who's getting a big cut of the commission, and I can't get out of it. And it's a hard lesson to learn, but you are not special. I don't want to break it to you, but you are on Wall Street. Physicians are looked at like, it says, with the word sucker stamped on their forehead. It's just, that's the way it is. You say physician, and all I think about as a broker is how much dollars I am going to make from you.
Yep.
Right? Because you, number one, think you might know a lot because you're a physician. And you are smart, don't get me wrong. But when it comes to this, but you're not slick. I mean, you're smart, but you're not slick. Wall Street is slick and smart. And they know that you have the money and they can get it from you. It's an ugly thing. Right. But if you believe that you can get in on the Ubers on the ground floor, you are mistaken. You are not. And if you did, it was by mistake or by pure luck. Nobody actually knew that Uber was going to become an Uber, and it was in some venture capital portfolio somewhere where, holy moly, this little thing that we never expected to do well actually did well. But it wasn't by design. Right. Anyway, you got to stay away from that stuff. You are not special. You are not. And
I think that's
why you should outperform.
Yeah, no, I think that's very good advice. And I think that's exactly it. These are the things that commonly questions other physicians always have is, well, there's this and there's this. And you're absolutely right. We may be intelligent in the specifics of our field, but man, we are looked at as targets by a lot of unscrupulous advisors and firms. So I'm glad you came out very strongly in what you're saying about that, because I think that's what people need to hear. So, Rick, I want to thank you for coming on the podcast. I really appreciate you going over your philosophy. And I want to encourage people to if they want to find out more about you, where can they get more information?
So I have two websites. One is rickferri.com, rickferri.com. And the other is that Core 4 portfolio website, which is core, the word core, CORE, -4.com, core-4.com. And that has all simple model portfolios on it. Now, I will say to your listeners that I am currently under a non-compete that is over with in about 2 months. And then I will be open for business, and I will be charging people by the hour for advice. And that's all. I'm not selling anything. I'm not managing money. I will be just charging people by the hour to help them with their portfolio and send you on your way, or help you find a good advisor to work with after that to implement your strategy. So that's my business going forward.
Awesome. That's our favorite model of advice. So charging but not selling, charging but by the hour. Perfect. So yes, I'll put a link to those on the show notes as well. And we look forward to, when your book comes out and then seeing you give your various talks. So Rick, thank you very much.
Well, thank you for having me.
I want to thank my guest today, Rick Ferri, for coming on the podcast and giving us his approach to portfolio construction and investing education. You can find out more about Rick at his website, rickferri.com, rickferri.com, and core-4.com for his list of principles and publications. Those links will be on the show notes. He also started the new Boggleheads on Investing podcast, so be sure to check that out, as well as his book that he's currently writing, The Education of an Index Investor. Remember, simplicity generally trumps complexity in most things, so investing is no different. Thanks for joining us on another episode of Dr. Money Matters. If this is the first episode you have heard, I appreciate you taking the time out and listening, and encourage you to listen to our past episodes. I would also appreciate you leaving me a positive review on Apple Podcasts, and also recommend you join our Facebook group where we have ongoing discussions about this and other topics in order to help each other reach our financial goals. Finally, I encourage you to subscribe to our email list and also to subscribe to the podcast itself on the various podcast app that you use in order to be kept aware when the latest episode comes out. More episodes of this podcast are available at www.drmoneymatters.com and on Apple Podcasts, Google Play, Stitcher, Spotify, or wherever you listen to your podcasts. Audio versions are also available on YouTube and Facebook. And you can follow me on Twitter at Dr. Money Matters, or on Facebook or Instagram at Dr. Money Matters, all spelled out. Thanks for listening, and if you get a chance, please leave a positive review for this podcast, as it helps move the podcast up the rankings on iTunes. And gets it exposed to a wider audience. Thanks for listening once again, and stay tuned for another episode coming soon.